Good afternoon. It's 11:30 and we decided to get this continuing education webinar going. I'd like to thank you on behalf of Lutz for joining us. Hope to have a little conversational webinar that is an education. I got to do the disclaimer. This is educational. This is not intended for advice directly. We hope you guys will learn something. Glean some sort of example, some sort of scenario that may be appropriate to you or a client. And that's the objective here, is to educate. Definitely not to give direct advice on any particular thing. So I'm here with Eryka Morehead from Collaborative, and we're gonna wish everybody a happy Valentine's Day to start. If you didn't know it was Valentine's Day, we suggest you can still probably get the reservation or some flowers or the scramble for the cards at the supermarket here when you can. If you did know it's Valentine's Day and you're here to talk about insurance and wealth protection, it'll be a great conversation piece for your significant others. And if you're like me, after 24 years of marriage, she's probably bored with everything else. So who knows, maybe disability and insurance planning is something that she might like to talk about now. So, but no, we just wanted to say welcome and thanks for spending your Valentine's Day with us. So without further ado, I want to introduce Eryka Morehead. My name is Justin Vossen. I'm at Lutz Financial. Eryka is with Collaborative Insurance Solutions, and I'll let you tell a little bit about what you do and how we work together with clients.
Yeah, thanks, Justin. Well, again, yes, thank you for spending your Valentine's Day lunch with us and hopefully dinner with your significant other. So Collaborative Insurance Solutions, we do just that, insurance. So life insurance, disability insurance, long-term care insurance, and an occasional fixed annuity for a tax play, Justin. So we are excited to spend some time together this afternoon just talking through this topic of risk management and protection.
Yeah, and again, my name is Justin Vossen. I'm a partner at Lutz Financial. I think Eryka and I were just talking. We've been about almost 30 years between each other here in the business, and we do financial planning and investment management. We also do some 401k solutions. But I think that the way we work together and why we bring Eryka here into the webinar and why we want to talk about this is, we feel that a good financial plan is both offense and defense. There's elements of it that you want to be defensive with and you want to protect. And so we look at the overall financial plan, and when we want to deliver some defensive product or something like that, we bring Eryka and her group in here to help fill that need that we think that a client has. And it's a piece of their overall financial plan. But the financial plan, I will say right off the bat, everybody's got a completely different situation. I've never seen two that are exactly alike, whether it be family or business or, assets or liabilities or whatever that may be. Everybody's got a really unique financial plan. So what we're going to talk about today as we walk into it, and this is Lutz Financial. We manage about $2 billion in assets here. And from our expertise as a tax firm is where we got our basis. We've added this SEC registered investment advisor. And like I said, the three things we do mainly are financial planning, investment advisory, and retirement plan services. So with that financial planning for all of our clients, we really take an in-depth look, and that's where we see where these insurance and wealth planning strategies kind of come into play. Let Eryka discuss a little bit of her overview with CIS.
Yeah, so the beauty of this relationship is Lutz and team gets to talk about living long, healthy lives to retirement and all the great things that's going to look like. And then it's our job to come in and say, well, what about this? And what about this? And what about this? And what about that? So all the things that you don't want to talk about, like getting disabled prematurely, passing away prematurely, needing long-term care, and those types of events. So we are an independent broker, which just use the analogy as a real estate. So essentially think of us as a buyer's agent in real estate. We are able to represent our clients, kind of take them to the market of carriers and figure out which carrier is likely to offer the best rate or the best contractual provisions for the type of risk that we are solving for.
So we're going to delve into life insurance. And I think the object again of this webinar is to kind of inform you some different thoughts. I think it's fairly, it's fairly simple to why you need life insurance, and that's to protect your family or your business or something in an untimely demise. And so we kind of want to take a little bit of a different slant with that today and kind of discuss a little bit of an overview of life insurance and kind of where it sits today and what we see, and then maybe some thoughts and some solutions that maybe aren't quite as intuitive to folks with, whether it be wealth replacement or some charitable strategies or whatnot. There might be some other thoughts that aren't just as intuitive as just replacing the that income loss if somebody were to pass away. And I think it's interesting. We pulled together some statistics here that, there's 100 million people uninsured, underinsured Americans today that say they may need more life insurance coverage or coverage at all. Even 10% of affluent families feel that they have the right wealth protection in place. And I think that's interesting. I think it's not that they don't have any in place, but when they come into our office, they don't know if it's adequate. They've been had it for years and has never updated it, and their plan has changed or whatnot. So, those people who walk in really don't know how much insurance they need. And so it's our job to kind of put pencil to paper and discuss what they need to replace and what that insurance would be used for in the event of an untimely passing. So I think it's really interesting that term insurance, as prevalent as it is, accounts for about 39% of the policies in place, and permanent whole life, universal life, that insurance coverage accounted for about 61% of that in place. And I think that's important to me, as we always work to try to maximize those benefits and maximize those death benefits if there's an untimely passing, that there's such a disparity between the two. I think as time has gone on, term insurance has continued to be more of a prevalent role, just as things have changed and evolved in the insurance business over time. But I did think that was interesting that less than half are in term policies. And, this is a women financial literacy seminar kind of series that we're doing here at Lutz. And so we pulled, I think, kind of a sad number that I think would hopefully get to be addressed better over time. Is that 41% of these single mothers own life insurance at all, and 59% of them feel they need to add coverage or get coverage at all. So it's prevalent, and again, it goes back to what affluent families feel and what other families feel is they just don't know how much they need and how much they have in place. So like I said, everybody's got a unique situation. It's important, I think, to really sit down and define that with an advisor or with somebody else who understands the whole financial picture and not just trying to sell something or, hey, here's a product that's really cool, you need it. You have to really walk through and quantify those numbers.
Yeah, so to kind of elaborate a little bit more on some of those statistics and what Justin was just mentioning, this kind of disparity between the amount of term policies in force versus permanent policies in force. I think if we think about life insurance at its core, right, it is a pure protection product, just like homeowners insurance or auto insurance. And so we like to focus on, death benefit first. What amount of insurance would need to come in, kind of get up and go to work every day and be invested in order to replace income to the family if someone were to pass away prematurely. So first and foremost, we always want to kind of start with that need, the gaps inside of the financial plan. Aside from just addressing needs or gaps in financial plans, life insurance can also be a very efficient tool, helping to provide for things like estate liquidity or a more tax-efficient wealth transfer in some scenarios. There's a lot of different ways that life insurance can be used. So oftentimes it is that needs-based, kind of what is the gap in the plan discussion, but there's also ways that life insurance can help boost the overall efficiency of the plan. And we're kind of here to help with both of those areas.
Yeah, I think that some of the other things that we look at too with with life insurance and other things, special needs trust, if you got to provide something for a family member, I think we've seen that more and more, and that's a highly specialized area. We suggest always talking with somebody, attorneys in that space, to try to, work with somebody who knows what they're doing, because there's a lot of Medicare provisions and Medicaid provisions that would fall into that you want to really, really be aware of. So I think, you work with a ton of business owners just like we do. And I think that is something, as partnerships evolve, and now we're starting to see second generation come into play. And what do you do on transition? And there's a lot of that going on right now. And so making sure these buy-sell provisions are in place and are good and are tight and don't cause problems should a partner pass, be disabled. We'll talk about that in a little bit. Or, God forbid, if there's a dissolution of the partnership or they just can't get along, whatever that may be, having some of this, those buy-sell agreements, and then this cross-purchase protection. And I know you do a lot of that, where they each own the other policy on the other partner, key man or whatnot. And that's another one, is the key man protection. Do you have somebody inside of your business, and if they woke up and weren't there, or didn't wake up tomorrow, would the business suffer, and how much would that suffer? Quantify that, and make sure that as a business, your business can thrive, and provide a stopgap with some other assets to make up to training the next person in, or replacing that person with a higher salaried employee, or whatever that may be. So we're really seeing a lot of that stuff is these businesses that have continued to grow, and obviously things expand. And these owners, they might have put something together 20 years ago, and we see that all the time, and have $1 million life insurance policy. Now they got a $10 million business. Is that adequate? It's something that you always got to have your thumb on as well too. So.
Yeah, and I'd say, we'll frequently have situations where the business maybe has buy-sell provisions in some sort of an operating agreement. So maybe we're speaking with the business owner, and there's multiple owners, and they're like, we're not really sure if we have a buy-sell agreement. But the reality is there is language there, maybe not in a buy-sell agreement, but in an operating agreement that actually obligates a partner or a couple partners to act in the event that something happens to one of the partners. And so what that's actually doing is creating a liability on the balance sheet of the surviving partner at the time the other partner is deceased. And just that lack of awareness of how the formula works or how the multiplier works, it can be very concerning to know that there's this liability out there that you have no control over the time in which it happens, that if left unfunded could put the business or the partner particularly in a cash crunch. So just reviewing those agreements, understanding if there is a liability that would pop up in the future if one of those terrible events like a premature death or disability would happen, and then being able to just make an informed, educated decision on, do I want to fund that future liability? If so, life insurance is one way that can be funded. If not, that's okay. We are just very passionate about making sure that there are no surprises at that time as to what the financial obligations are going to look like.
Yeah, and truly, it's the spouse, fortunately, that is going to be interacting with a partner, and they may be family, they may not be family, and that spouse is going to want to extract value from that company if that person's no longer there, because now they're on their own and reassessing what things are going on. So even your spouse, to me, has to have a significant understanding of that. Otherwise, it just creates a situation, and we've seen it where people question, maybe how much the business is valued and whether that remaining partner is being fair to the deceased partner and the deceased partner's family. And, the remaining partner now has to manage a business on their own or something like that. So they've got more responsibility. And so they might feel that their value is worth more than going forward than what they may think they should pay that remaining spouse. So tightening that up and doing it ahead of time and dusting them off every few years is huge as businesses evolve and partnerships evolve.
For sure.
So one thing we won't spend a ton of time on, I know Eryka mentioned that, the estate issue and providing some liquidity to estate. And we see it in farm properties where you don't want to sell the family farm to pay an estate tax bill. And the estate tax exemption has run up to quite a bit now and sitting roughly 14 million or close to 14 million. That's per person. So really it's significant assets that are in play potentially with people with significant wealth. But we just want to kind of remind everybody, and this is going to become probably a bigger conversation at the end of this year and into next, is this is changing and cutting back in half and sunsetting on January 1st, 2026. So that roughly 14 million is going to be cut in half down the road, assuming nothing happens in Congress. And we all know, who knows what's going to come out of Congress in the next 2 years or 2 days. So I think that that's something we want to keep people top of mind as this stuff evolves and changes.
For sure, just being proactive with that planning. I think for those of us that were around in 2012, we're just preparing for this to kind of be like deja vu all over again. We're not going to know until the 11th hour. So the more we can do to plan ahead, plan now, and be prepared, because these times are definitely make it very taxing on the professionals that are going to kind of help put these plans in place.
Yeah. The reason we go back on this slide to 2000 is just to show you over the past 25 years how much things have changed. So we can pretty much bet that the next 25 years things will change and evolve, and again, keeping our finger on the pulse of it. So Eryka was going to walk through a quick little case study on some life insurance in a situation that may or may not be relevant to you, but something that we really thought, hey, we walk through a real time solution to this.
Yeah, so here we go. As you can see kind of on these slides here, 42-year-old healthy female, 4 kids, primary income earner for the family, key employee in the company that she works for, $500,000 a year of income. And also from a key employee standpoint is generating a significant portion of the revenue for that company. So the questions that we like to kind of look at are, we call them our 3 different lenses of the business. If she were to stay alive and working, not only is she building an asset on her balance sheet in being an owner of the company, being a significant revenue generator for the company itself, but personally, if she stays alive and works, that's a great amount of income to have coming in, which is providing lifestyle for her children and her family. That cash flow coming in on an annual basis tends to be what kind of governs all the decisions we make in life, right? As parents, we get all of these fun choices like, are we going to buy that first car? Are we going to make them buy the first car? Are we going to pay for college, and to what extent? What size wedding are we going to be okay with? What neighborhood are we going to live in? What schools are they going to go to? And all of those decisions do not need to be made ahead of time, so we can calculate some magical exact amount of life insurance. We like to focus on, if you weren't here to get up and go to work every day, you would rely on your investments to get up and go to work every day and produce that income in your absence. And so for this particular situation, what does that personal coverage look like? How much insurance will there need to be on top of other assets that have already been saved that can get up and go to work and provide whatever level of income replacement coverage that family would like to have? Now, if we kind of close the first lens, the personal lens, that's a certain amount of insurance, and it's usually personally owned and personally paid for. It's kind of covering that income, that wage, if you will, that is being taken out of the business. But the business itself has a very different view of the situation. The business itself is saying, okay, if she's not here to get up and go to work every day and generate the revenue for the business, what does that do to the value of the business? And so that's where key employee coverage comes in. And you will most of the time see key employees, or even with business owners, there will be separate insurance for each of those separate needs because they're covering different economic risks.
Who typically owns and pays for that type of coverage if you're a small business?
Yeah, that's getting interesting right now with some of the court cases going around, which this isn't here today to talk about the court cases and which, circuit feels which way. Typically, in a small business, you would see those as cross-purchase agreements, meaning partner A purchases a policy on the life of partner B if we're talking about a buy-sell agreement. Now,
Even key man?
key employee coverage that we want to stay in the business, for the business, to help protect the business, those policies are going to typically be owned, paid for, and have the beneficiary be the business. The reason I bring up this little nuance though right now and kind of broaden the conversation to buy-sell coverage is there's a couple conflicting court cases and rulings on if for buy-sell purposes, not key employee, the business is the owner of the coverage. Does the insurance increase the value of the company before it is kind of the deceased individual's estate is valued? Or is it the value of the actual business before the insurance got added to the business account when the death benefit paid? So interesting conversations going on there right now, but definitely personal coverage, personally owned, key employee coverage is typically business owned.
And a little bit of housekeeping here. If you do have questions, feel free. Reagan has graciously sat here with us and listening and watching the chat, and she's going to be able to key us in on some any questions you might have. We'll also allow for some questions at the end if you want to wait as well. So feel free to chime in as we discuss these things. So no, I think just to kind of put a bow around that, I think again back to the overall financial plan, all these considerations from the business's perspective. And so that would be doing planning for the business owner, making sure they have that key employee insurance, making sure they can adequately value what that key employee is bringing to the table or what that partner is bringing to the table. And then back to the single person coverage and just their natural coverage, how much that is impacted as far as that lost salary for whoever they need to take care of, whether that's kids or spouse, or, we see it a lot now with aging parents and stuff. And we need to provide some things for that too, and just to make sure that if something happens and they're planning on taking care of their parents, that they have enough to do that. So,
yeah.
So I think the next thing we wanted to walk into is disability insurance. And this is specifically long-term disability. And I think some key statistics here, and this is when people walk into our office, whether that be a younger person or older person or business owner or wherever they're at in life, disability and long-term disability specifically seems to be the biggest field. I don't know if that's where you guys see as well, because sometimes, and I'll skip down to that last bullet point, only about a little more than half of companies offer long-term disability for their employees. And 33% of those workers, the International Foundation of Employee Benefits says that they opt into it. So it's woefully underserved in this market to get that policy. And then it's even more difficult if you're going to go out on your own and try to find a policy and price a policy and walk through all the things that you walk through people about what's covered, what's not, own occupation versus any occupation and things like that. But really, if you're a 42-year-old, so kind of mid-career of your life, you're 4 times more likely to experience a disability, a long-term disability, than you are to die. I think people find themselves thinking about life insurance more, but actually the biggest risk potentially is that loss of income or not being able to work or not being able to work in the job that you customarily or trained for or whatever. And you have to do something that's less money and obviously less, less of a job, I should say. So, the statistics are overwhelming that this disability and the long-term disability specifically is probably one of an individual's biggest risk, and yet it's probably the most difficult to insure, and then what we see in practice insuring it all. So, and I don't know if that's your experience as well, but.
Yeah, I think, if we think about it, our cash flow, it guides everything that we do, from how much we're going to save, when we're going to retire, what we're going to invest, but also the lifestyle that we're going to experience with our families. And life insurance, you talk about disability being a little more complicated. being dead or alive, that's pretty black and white, right?
Yeah.
At least as I know it to be. It sounds like it's pretty black and white.
Fair enough.
But with disability, there gets to be all this like gray area. And people are like, well, when would I be considered disabled versus when would I not? And I think we also, our society as a whole is kind of tending to rely more and more just on our employers that they have us taken care of. You know, they offer us health insurance because they know we need it. They maybe are not offering us disability because they decided that we don't need it. And so there's kind of this reliance, right, wrong, or indifferent on the employer, or just, and this shift in my employer's got me taken care of.
Right.
So to your point, yes, I think it is one of the most undermet needs that we see when people walk in the door. You know, do you have life insurance? They can usually answer that yes or no. And they might not be exactly sure on how much they do or don't have. But when we ask the question, do you have disability insurance? Most of the time it's, I don't know, or my employer, yeah, I think so through my employer.
Or they don't know if they signed up.
No
Literally,
clue.
very few people can tell me whether they've elected it or not. They have to kind of log into their HR portal and say,
Yes.
oh yeah, I elected it, or oh yeah, my company pays for it, or oh shoot, I haven't elected it.
Yes, yes. So for everybody on the line today, your one takeaway,
Yes.
if you would, just please inquire, find out, do you have disability insurance? And if so, how much does it cover? And that's kind of what this next screen here is to talk about. When we hear people say, yes, I have disability insurance. So if you look at the top line there, that's current income if you were alive and working. We clearly had to make some assumptions here for tax bracket, but if you see current income after tax, right? We do have this thing called taxes that most people pay that takes part of your total income and kind of trims that down. So if your current income after tax in this like example is say about 78%, oftentimes people will tell us, well, I have 60% coverage through my employer. So they're thinking in their mind, all right, I'm living off of 78%. My employer's got me covered to 60%. That's not that big of a difference. But the reality is, if your employer is paying for it and you are not being taxed on the economic benefit of it, oftentimes we find that people's group is taxable. Their group benefit would become taxable for them. So now we go from 100% in the current income alive and well and working, receiving about 78% after tax. Once we take tax into a taxable group disability policy, your now net take home is about 40% or 40% of your gross earnings. Almost half of oftentimes what people are expecting it to be. So as I mentioned previously, I mean, it's Valentine's Day. I'm okay with surprises, maybe some flowers, some chocolates, those types of things. But we just really want to make sure that there aren't surprises at the time that incident happens, that diagnosis with cancer, that aneurysm, whatever other terrible thing we can think of that would possibly be ailing us and making it so we can't get up and go to work every day. We just want to make sure we're not finding out at that time. Because at that time, there's absolutely nothing we can do about it, that we're actually going to be living on half of what we thought.
And you can't really insure 100% of your salary. The insurance companies won't let you because it's a moral hazard to them that you go sit home and eat chocolates and hang out all day.
Right.
I think that's, 60 to 70% is probably 70% is probably the highest I've seen. And then it's really important to understand who's paying for that benefit. Or paying for the premiums, I should say, because when the benefit comes, if it comes, that basically results in what taxability or what the taxability of that benefit is. Because if you pay for your own policy with your money, with your income after tax, that benefit's going to be tax-free to you. If your company is paying that benefit, or excuse me, for those premiums, and then you receive that benefit, that's like this graph where it's going to be taxed again when you receive that benefit. So when you're doing those calculations of am I covered or am I not covered, you've got to know the taxability of that benefit, because then that affects or effectively tells you how much you will receive after taxes and whether you're covered or not. So you can never insure your whole thing, your whole salary, which is unfortunate, but at the same time, you got to make sure it's adequate enough, especially if you're the sole income earner in your family, or, there's no other alternatives. And the final thing on this disability, before we get to a quick example, is it only lasts usually, and it's dependent on the policy, till about 65. I've seen some stretch to 67, and there's some provisions, whether you start earning the benefit later in life, you get 5 years guaranteed or whatnot, or 10 years guaranteed. But at the end of the day, it's not guaranteed for the rest of your life. It's only guaranteed to the quote unquote your retirement, or as it's defined by your policy.
Right, so you still gotta make sure that if you suffered a disability and that policy is gonna pay till this retirement age, that you're still going to have a plan and a portfolio at retirement to be able to kind of carry you through the rest of your life. So this example here, we talked about the business owner as it relates to life insurance, which is what people most commonly think of. But as the statistics show us, we're far more likely to see that key employee or that business partner suffer a disability, which is making them unable to go to work, versus a premature death. And so it is possible to fund that buy-sell agreement or fund coverage on that key employee for disability as well. So we want to make sure, again, reading that operating agreement or that buy-sell agreement, that we know what is the obligation. So if I'm a partner here that is disabled and that document says basically 12 months from now, we're going to determine whether I'm going to continue to be disabled or not, and that's going to trigger a buyout, we're back to, in our earlier conversation, this liability being created on the balance sheet instantly of the non-disabled partner. So just understanding the legal agreements, what they commit us to, and being able to thoughtfully choose what we would want our funding sources to be before an issue has arose or that situation has occurred.
And I think this is a one business owners, everybody thinks about the death part of it, back to being underinsured for disability. Nobody really thinks about if their partners get disabled. And to me, that's almost worse, because the partner who's left still has to run the business, loses the contribution of that partner who's now disabled. That partner still needs probably some revenue from the business. And if you don't have it on paper, potentially that partner still owns half of the business and continues to receive their dividends. And, they have to bring in somebody else to pull that partner's weight who's disabled. So that lowers the overall value of the business overall. So if you don't have some sort of policy in place to account for that or provide for that difference in value, you're going to significantly lower the overall value of the business. And it's not going to be anybody's fault, but at the same time, you just want to talk about these and think through these provisions and make sure there's some sort of agreement in place to make sure it gets taken care of.
For sure. Okay, so for our example here, we've got a 34-year-old doctor with a $300,000 salary, just finished residency, kind of starting out. Especially with these specialty physicians, oftentimes we'll see that income increase very substantially there after residency and a couple years in practice. So 32-year-old or so spouse here is not working, 2 young children, there's school loans, just purchased a home, and the health system that doctor just went to work for is providing $10,000 per month. That is a max. So when we say 60% of earnings, there is, I'm going to say always, most of the time there's a monthly max. I think in 16 years of doing this, I've seen 2 plans that didn't have a monthly max because it was a large organization and a self-funded plan. But most of the time, the language will read, you get 60% or some percentage of your earnings, but up to a monthly max. So make sure you're knowing what that cap is. In this case, it's taxable because it's a W-2 employee. And it's a 90-day elimination. Definition of earnings is another important thing we want to pay attention to. Whether or not K-1s are included for any sort of person who is an owner in a business. Because again, that fine print of the disability, the group contract, can dramatically impact the actual calculation there. So in this particular example, we're also talking about health considerations. There's been an anxiety medication taken for the last 5 years. So with the calculation, because it's taxable based on the income, there's an additional $5,000 per month gap. And so what we would want to do here is actually kind of go to the market and say, okay, with this anxiety condition, how is that going to impact the coverage that's going to be available? Most of the carriers are going to be very, very similar, the disability companies, and how much benefit they will offer, but they may vary widely on how they're going to treat that particular condition. A group, the mental nervous condition being this in our example here.
Because some carriers won't even touch it, right?
Yep, so some will say it's excluded altogether. Some carriers, like a group contract, typically only has 24 months of mental nervous coverage built into it to begin with. So they might say we're fine with it because we already have this exposure limitation. Whereas other carriers who have unlimited mental nervous coverage, they will treat anything stress, anxiety, depression, addiction, dependency, like they would treat cancer or any other type of disabling condition. Those carriers might say we want to exclude it, or we're going to just place that 24-month limitation on it.
Really?
And that's where, again, being in an independent capacity to be able to go to the market, to approach each of the carriers and say, based on these financials, based on this health pattern, what would that look like?
And does that vary across industry and age? And, does some carrier come back and say, well, this is a 45-year-old physician, we're going to price that better than we will the 25-year-old physician, depending on their asset mix or whatnot? That's
a really good question. So in the life insurance industry, you get ratings like, super preferred, standard, tobacco non, etc. In the disability, yes, premium is based on age, but you're actually you're rated based on your occupation class, meaning like you have a super not risky occupation class all the way down to, maybe you work in a cattle yard and it's almost certain that you're going to be disabled at some point in time. And that's kind of the spectrum of occupation classes.
We had one and somebody owned a roofing company. Yeah. And they got rated like they were walking all over the roofs, and we had to define that with them just because, they were in management and running the company. They're not sitting around doing appraisals of roofs all the time. I mean, they got classified in a super risky category that we had to kind of come back on. And so It's not just take it or leave it what you get. You sometimes have to work with it. Right?
Yes. And that's kind of what we're here is to to be that voice for the client to make sure that the insurance company is seeing all the facts in the right light, and being able to make an educated decision about what the risk of a certain person's occupation or the percentage of time they're spending physically on a roof versus in the office, maybe doing bids, managing finances, etc.
Got it. Oh, sorry, we have to do the polling question. This is a tough one. So you have to, in order to get your CPE credit, you have to answer this question. And it looks like we've got a couple questions that we want to address here real quick. First one is, does Lutz work with clients to set up a complete financial plan, including retirement plan setup? Yeah, so we do financial planning for a fee, where we'll sit down and it's usually a 4 to 5 meeting process. Where we'll sit down and discuss all the aspects, including insurance, including employee benefits, education, estate planning. We don't do the estate plans. We've got a lot of lawyer friends who will do that for you, but we'll at least kind of put it on paper and show you what you have and offer some advice about whether you need to change it or whatnot. But retirement plan setup. Now the actual, employer plans, we do have a group that does that. But we will offer advice on kind of what the offerings are in the 401k or 403b or whatever that might be to do that and do those allocations. So the answer is yes. Then there was another one. We talked about business owners and life insurance. Do business owners need a disability insurance, or can they just continue to pay themselves? Answer that.
So for the business owner, sure, they could continue to pay themselves. The challenge though is the duties, the roles, the responsibility that the business owner is performing for the company typically need to be performed by someone else in their absence. And so now if you are continuing to pay yourself while paying someone else, you've just increased your payroll there. Well, as business owners know, the value of the business is defined by a multiple of profits. And so if you're now paying yourself and paying someone else to do the job because they're doing the job you're not there to do, you've now just decreased your profits, thus kind of devaluing your business at the same time. So it's a tricky interrelation there between all of those things.
Well, I would say not only does your value get affected by somebody you have to hire, but that time period or that incremental period where you have to find that person or train that person up. I mean, I don't know a business owner that I work with that's not integral into the day-to-day operations of their business.
Yeah.
Very few, maybe one or two, but at the same time, not only does that interruption happen and you have to figure out that stopgap, and probably that person you're hiring is not going to do it as well or as passionate as you are as a business too. So I think that also affects value.
For sure.
The final topic we want to address, and I'm going to let Eryka kind of walk into this with some different thoughts, but long-term care. Again, I always say that there's ways to cover long-term care. You don't have to buy long-term care insurance. You could fund it with insurance. There's varying degrees and types of it, which we'll discuss real quickly, or you can leave it up to your kids and cross your fingers. And maybe the state has a plan for you, which is, through Medicaid, not advisable. And if that happens, we won't get into that too much, but you have some Medicaid provisions that you have to spend down the assets. So, regardless whether you get it or not, I think you have to discuss it, and you have to discuss it as part of your plan. Who's making the decision? Do you want to leave it on somebody else? And hopefully somebody takes care of you, or do you want to take care of it yourself?
Perfect. So you see the statistics on the screen here are kind of staggering. When you look at the total amount of people that have Alzheimer's dementia, you're 6 million people just in 2021, and that is growing at a very accelerated rate. So I just want to share for a moment, while we're going to talk a lot about like numbers on these slides and products, I've kind of lived this journey of long-term care, not only in my professional life, and this is obviously what I do and have helped a number of families with these transitions, but also as the oldest daughter of 4 children, I have had a mother with an early onset, so 59 when diagnosed with this condition. So having lived the transition to independent living, assisted living, personally, I just want to take a moment, and while we tend to focus on the dollars and cents, there is a very emotional behavioral side to this long-term care insurance topic and the choice to fund it with an insurance contract or not fund it with an insurance contract. When we're having these conversations about where is the best place to receive care, how do we want to receive that care, who is going to provide that care, it really allows families to think about it in a completely different light when cost isn't the driving factor. When you can remove that and say, we have this insurance policy and it is here to provide the care, whether we want it in a facility, we want it at home, or whether we want to kind of take care of a family member, it really changes the dynamics of that conversation.
And I've noticed too, if somebody does move to care after an event, whether it be a stroke or heart attack or something where they're receiving really good care and in a really good facility that Medicare is paying for, and they have to look at other options if they have to extend their stay, sometimes those other options don't come with the bells and whistles, and they prefer to want to stay in the really, really nice place with all the bells and whistles and everything like that too.
Yeah.
So.
Yeah. So all sorts of different types and options and details out there, but I think the number one choice, or the number one topic that always comes up is, do I need a long-term care policy? And we'd really like to reframe that question to say, do I want a long-term care policy? Because as we mentioned, there's kind of pros and cons financially to having one versus not, but there are also pros and cons behaviorally at the time that is needed. So I'll give an example here. I was working with a family who was having a really, really, really hard time getting dad to allow care to come into the home, just didn't want it, but actually had a long-term care policy. And the family had reached out because he was getting a rate increase on the long-term care policy and just said, what do we do with this rate increase? And I'm looking at the situation, this individual is in a wheelchair. I know the spouse is providing a ton of support. And so just reframing that conversation with dad to say, you don't have to pay this rate increase. If we just go ahead and file a claim on this policy that he's clearly educated or, qualifies for at this time, and you just let somebody come in a couple times a week to help mom with just some of the light housekeeping duties and those types of things, like, remember, we don't reason and rationalize at these advanced stages like we would reason and rationalize today when we're making these decisions about to insure or not to insure. And immediately his answer was, well, why haven't we been doing that already? And it was just getting him to see that a little bit different light of not, hey, dad, you need this care, we need to get help. It was, hey, dad, we have this insurance policy, and if you just allow help to come in, this insurance company is going to start paying and you can stop paying. And he's like, huh.
My dad's not very stubborn and he'd be, I should have known this all the time and that would be your fault. So you got to know as a kid and as a relative or something, what those options are, because I know it would backfire tremendously in my folks' house.
Yes.
And to tie that up, I mean, we're not going to sit here and walk through the different types, but there are different types of long-term care plans that aren't the traditional buy it and then the cost is going to increase 20 times before I ever have to use it. There's different ways to solve that, which we're not going to get into now, but to the point where you want to either help a family member or do it yourself or think through that. I would say the earlier, the better you have these conversations about the different kinds of ways to solve for this. I think it helps in the underwriting, obviously, until you wait till some advanced age and the cost, right?
For sure, for sure. So just know there are fixed guaranteed products on the market today. That return premium, if you pass away and you don't use it, there's all sorts of types of products that are available today that were not available. Maybe if you looked at this in the past, or if you had challenges with, grandma, grandpa, or mom and dad's long-term care policy previously.
There is an answer too that you can self-insure. That's an answer. And I don't think sometimes in some instances it's a bad answer, but I think you got to answer the question to yourself, who's going to be making that decision? And this kind of gets into the example here. And am I putting an undue burden on them? And can I just solve for them too? So back to your original example with the guy who's like, well, shouldn't we be?
Yeah. And I think just listening to your spouse, they know if you're going to be a giant pain in the butt at the time that they're like, hey, I can't care for you anymore. We need to bring in help. Like if you look at your spouse and you're like, my spouse is going to be very difficult in the future if and when that situation occurs, that is the situation that should be looking at long-term care insurance.
We're not going to, And we're not going to solve for every situation here, but I think, this example real quickly, I think happens quite a bit is, there's a divorce, or I always say the best time to plan and look at your financial plan is when some sort of life event occurs. And in this case, there's a divorced female. She has 2 adult daughters. She's got a good salary. She's earning some alimony based on the divorce settlement, and then, a buyout from a business on the settlement as well that's going to occur to pay her over 20 years. So she's got a significant increase in her income above and beyond what her needs are. And she's got a good balance sheet, no debt. So all the financial things look really good. And this would be something you could consider solving for yourself and not having some sort of policy. But it's important to her, to not put that burden on her kids as she's on her own at this point, and basically wanted to make sure that she would be taken care of and had that to fall back on more as I think a diversification of her asset mix above and beyond just the annual income and then some portfolio or IRA or 403B. She wants to make sure that she's got that taken care of. And with that excess cash flow, you can look at a policy that's going to provide you a tax exempt income stream for long-term care down the road. And as Eryka mentioned, that some would still have a death benefit if you didn't need it. And then you can define that, but you're leveraging that balance sheet, I guess. And that's a good answer if both you have the need, the want, want, the desire, you can change that balance sheet mix to account for that. And, you know, again, solve for that problem that inevitably potentially will occur. So, you know, again, it's not for everybody. It's something that you've got to discuss and have that conversation. And would you agree, the earlier the better?
Yes, for sure.
So with that, I know we've talked a little bit, and I think we've left about 10 minutes for questions. If anybody has any, I know it's awkward to do the chat, but before we jump into this, I want to say thank you to Eryka Morehead from Collaborative Insurance Solutions. And you know, we talk almost, if not, you know, bi-weekly, on a weekly basis, and see these things. And you guys do a wonderful job with us as to providing what clients need, and not just something that trying to sell something. I know maybe insurance people and financial people that in general get painted with that brush, but and I think that's the biggest thing. None of this stuff should be sold. It should be providing solutions for somebody's needs, and it work with people that want to provide solutions and not just push a product that they think is better than the other product on the street. So Reagan, I want to thank you too for putting this together. So any questions? We've got a couple here. Could a wealth management discussion with Lutz include a discussion about key employee insurance? Absolutely. I mean, most people's balance sheet revolves around their business. And that's something we include in any retirement projections, and the value of that, or the annual income flows from that, and what we're saving, what we're spending, and how that incorporates in somebody's life. I think that's our bread and butter is businesses and business owners. And, you know, it's better to do that prior to transition. I always tell our M&A folks, I'm like, have us sit down with the person, because you're integrating that business with their personal financial life, and how that integrates before you have a transaction or before you do something drastic with the business, and what effects that has on you personally. You've got to be able to put that on paper and understand what that means. So
Justin, can you repeat that?
oh, I'm sorry. The question I'm asked to repeat the question. Could a wealth management discussion with Lutz include a discussion about key employee insurance? And the answer is yes. And that's back to this, how that business integrates and what you need to take care of in the business to provide for your future on the personal financial side is a huge part of that financial plan. So. Any more questions? This is really awkward doing these presentations in front of ourselves. So any questions would be great.
It's like anyone, I have to keep talking to Eryka.
Okay, Reagan, is there going to be a recording of this?
Everyone will get a recording and a copy of the PowerPoint.
All right, so we appreciate everybody taking some time out on their Valentine's Day. Hopefully, all their significant others are good to them today, and you guys enjoy the rest of your Valentine's Day, and appreciate you guys taking some time to spend with us. If there is any more questions or contact, you can always reach out to either one of our websites. We gave you the generic emails there, and you can find my email on our website, or Eryka's on hers as well if you want to contact us directly. But obviously, we probably didn't address specific questions here, but we're happy to have a chat. And anytime you want to reach out, if we don't know the answer, we'll hopefully point you in a direction that you can get an answer. Appreciate everybody's time.